President Biden and House Speaker McCarthy have reached a deal to suspend the debt ceiling until 2025 and fund the government for the next 2 years. This deal would prevent a catastrophic default that could hurt the market and the economy. But what does it mean for Americans, and how will it affect different sectors and programs? Let's take a look at some of the key points of the agreement. First, the deal would cap non-defense discretionary spending at current levels for 2024 and increase it by only 1%. For this means that most federal agencies and programs that are not related to national security would see little or no growth in their budgets. Some Republicans claim that this would save $29 billion over 2 years compared to Biden's proposed spending levels. Second, the deal would boost defense spending by 11% to $885 billion, matching Biden's budget request. This would allow the Pentagon to invest in modernizing its weapons systems, enhancing its readiness and addressing emerging threats. Third, the deal would claw back some unused COVID-19 relief funds, including money for vaccine research and disaster relief. The exact amount of savings is unclear, but some estimates range from $50 billion to $70 billion. The deal would also cut $400 million from the CDC's Global Health Fund, which Republicans say sends taxpayer money to China. Fourth, the deal would end the pause on student loan repayments that was extended by Biden until May. This means that millions of borrowers would have to resume paying their loans within 60 days of the bill's enactment. Some Democrats and advocates have criticized this move, saying it would harm struggling borrowers and slow down the economic recovery. Fifth, the deal would impose stricter work requirements on low-income Americans who benefit from federal food and health care programs. The deal would require adults up to age 54 to work at least 20 hours per week or participate in job training or education programs to qualify for SNAP benefits and Medicaid. The deal would also limit the amount of time that states can waive these requirements in areas with high unemployment. These are some of the main features of the debt ceiling deal that Biden and McCarthy have agreed on. The deal still needs to pass both chambers of Congress before it becomes law. Some lawmakers from both parties have expressed concerns or opposition to some aspects of the deal, so it is not certain that it will pass without changes or challenges. The deadline to raise the debt ceiling is June 15, so time is running out for Congress to act. The debt ceiling is the legal limit on how much the U.S. government can borrow to pay its bills. Every so often, Congress must vote to raise or suspend the ceiling, so it can borrow more to pay its bills. Currently it is $31.4 trillion. But what happens if Congress doesn't raise the debt ceiling? Well, the U.S. government would run out of money in default on its obligations. This would have disastrous consequences for the economy and the financial markets. It could trigger a global financial crisis, a spike in interest rates, a plunge in stock prices, a loss of confidence in the U.S. dollar, and a recession. That's why President Joe Biden and House Speaker Kevin McCarthy have reached an agreement to lift the debt ceiling and avoid a default. But the deal is not without costs. It includes some trade-offs that could hurt the market and the economy in several ways. One of the trade-offs is that the deal would suspend the $80 billion in new funding for the IRS that was approved in last year's Inflation Reduction Act. This funding was supposed to help the IRS enforce the tax code for wealthy Americans and close the tax gap, which is the difference between taxes owed and taxes paid. According to some estimates, the IRS could collect an additional $700 billion over 10 years with this funding. But without it, the IRS would have fewer resources to audit high-income taxpayers, corporations, and partnerships. This could mean less revenue for the government and more tax evasion for the rich. Another trade-off is that the deal would impose stricter work requirements on low-income Americans who benefit from federal food and healthcare programs. For example, it would require able-bodied adults without dependents to work at least 20 hours per week or participate in job training or education programs to receive food stamps. It would also allow states to impose work requirements on Medicaid recipients. These work requirements could reduce the number of people who receive these benefits and save money for the government. But they could also hurt the most vulnerable Americans who face barriers to finding and keeping jobs, such as lack of transportation, childcare, education, or skills. They could also reduce consumer spending and demand for goods and services in the economy. So while the debt ceiling deal may have averted a default crisis, it may also have some negative consequences for the market and the economy. It may reduce tax revenue, increase inequality, and hurt low-income Americans. These are some of the trade-offs that lawmakers had to make to reach a compromise and keep the government running.